So do you all see, please, the chapter 10, my screen?
Yes.
Okay, good. So just quick reminder of what we discussed last time. So in chapter 10, we started talking about so the property, plant and equipment. So the different, let's say, component of cost measurement of this property, plant and equipment. We highlighted different types of property, plant and equipment, like land, like equipment, building, machinery, and so on. And we discussed how or what are the major components of cost of land, equipment, and then we move to the most important part of this first year learning objective. It was about the self-constructed assets, and we dealt, of course, with the situation when you are borrowing money to finance, specifically, of course, to finance that self-constructed asset, either, of course, to be in use in the future for your own activity, or, of course, you are making that to be, let's say, sold or on behalf of another business. Okay, so in either situations, if you are borrowing money for that specific product or specific, of course, asset, you have to what, or you have the ability to capitalize the interest expense that you are incurring during the construction process, and as I said, over specifically that that money, of course, borrowed. Okay, of course, we discussed the main conditions to be able to apply that capitalization issue. So here, remember that it should be qualifying asset, meaning that it will require a long time of period to be ready for its intended use. Don't forget that the capitalization period starts when we start actually incurring expenditures related to that in progress, of course, construction assets, and it will end up when, of course, the asset is ready for its intended use. Okay. And then, of course, we talked about the how much to be capitalized. Remember, we should capitalize the lower between actual interest cost and the avoidable interest expense. How we measure that, of course, by applying this weighted average accumulated expenditure, of course, method. Okay, so that's what we discussed last time, and also we have shown, of course, how to record the construction in process, all the expenditures that we incur, and of course the interest expense that we capitalize it. So remember, when we say capitalizing interest expense, meaning that this amount will be part of the cost of the asset, not as a part of the expense, of course, as shown will be in the income statement. Okay. So this is what we discussed last time. Do you have any question, any problem, any issue, please, to discuss before we move on? All good?
Yes, normalement.
Normalement. Okay, so I assume that it's clear. I guess we stop at this level. So after, of course, making that journal entry recording, as I said, for January 1st, for example, here, what we are incurring as in process, of course, expenditure for the construction of that building. So we can, of course, debit the construction in process account, or simply the building, of course, account. We credit cash for what we paid for. We continue for every expenditure that we made by, as I said, debiting either the asset itself account or the construction in process account. Until, of course, at the end, when we have, of course, finished working on that asset, we will what? We will, so this is not, and we still, it is, of course, over on December 31. So this is, of course, the last maybe expenditure. And we have also, don't forget that we have to record the interest expense that we are allowed to capitalize here. So still here, see, it will be debiting still the building account. The difference, as I said, between the interest expense, the whole interest expense, because You know that for businesses, we have other credits, other outstanding debt, and we'll be incurring, of course, interest expense on that outstanding debt, okay? So my entire interest cost, in this example, it is, let's say, $239,000, but you are allowed to capitalize 120, meaning to include the 120 into the building, of course, cost, and the remaining, of course, will be expensed as it is seen in this journal entry. So this is, of course, about the journal entry. If you are, of course, preparing an income statement for that firm, you should also provide that information either, of course, in the income statement, or you just need to provide the interest expense, the appropriate 119, and just provide these details, the detailed information regarding capitalization of interest, etc., in the notes disclosure, okay? So you just need to decide or choose one of these ways of presentation, okay? Some businesses may just prefer to provide information about the interest expense, so the net amount, which is 120, and then go to the note disclosure, talking about in this way. For example, during 2019, we have a total cost of interest cost that was 239, and of course we capitalized it, of which 120, and we just expensed 119, okay? We also provide information about the capitalization rate, which was, of course, weighted average interest rate. As if you remember, of course, we measured that for the amount that is above that we need, of course, to finish and construct that project over the specific broad amount. Okay, so that's all for that interest cost during constructions. Okay. So just here to talk quickly about special issues regarding to the interest capitalization. So when you have, for example, you are making, let's say, you borrow money, of course, and you need that money for land, okay? So you will be purchasing, of course, land. And of course, if this land, we have actually two situations. Should we, for example, the question here, should we capitalize or increase the cost of the land with the interest here that we are allowed to be capitalized? So the answer depends on the use of that land, okay? So if you, as of course a businessman, you are purchasing that land for specific here building of a site. So here over, of course, the site for structure, meaning you will be making a building over that site. Of course, it's obvious that the interest that will be capitalized will be what? Included in the building here or in the structure cost. So it will be not part of the plant or the land here. So talking about the land, of course, at the plant site here, it won't be including the interest here, the amount of interest capitalized, okay? So please, to just summarize the idea here, you may borrow money for your project, and this project will have as a first step that you will be acquiring a land. So should I include the interest, of course, amount of interest capitalized into the land cost, or should I expense it or on another account, etc.? As I said, the answer will be depending on the use of that land. So if I will need that land to build a construction over that land, obviously the interest capitalized will be what will be part of that construction cost, not the cost of land, you see? But of course, if I just purchase that land to be, of course, developed, let's say, for example, divided into lots, and then, of course, maybe improve it and sold, etc. So any capitalized interest will be, of course, part of that cost of acquisition of that land. Okay? So in summary, the interest capitalization when you purchase a land should be what? Should be allocated based on the use of that land. So if it is a site for construction, it will be part of the construction cost. If it is just to be developed and to be divided in lots and then sold, of course, the interest cost here will be part of the land cost, okay? So that's one of the issue regarding the interest capitalization. Another issue is that you as a firm, for example, or as a businessman, as a wise maybe decision, if you just borrow, I don't know, let's assume $500,000. This, of course, this money that will be allocated for the this project of construction of one building, but of course you won't use the entire amount from the beginning. For example, you borrowed, you had that money on January 1st available, and you will be paying, for example, or will be using this money to pay for all materials, for all labor maybe needed, etc. Per, for example, trimester or by quarter, meaning or semester, etc. So you'll be, for example, making expenditure on March, on April, I don't know, on June, July, etc. So you, of course, start making this payment whenever, of course, it is needed, but you will have certainly extra money. And this extra money, of course, it is wise to what? To make it, of course, to invest this money, for example, in a bank deposit, and you will be gaining or making interest revenue, okay? Or you may even purchase short-term, for example, shares or notes, etc., on capital market. So it will make sure that you will have what? Return over that investment within a short period of time, okay? So the question here is, if when we borrow money, and this money, of course, is intended to finance the construction of that building site or whatever project, at the same time, you'll use portion of that money and invest it in capital market, and you will have will be earning revenues, interest revenue, because of that investment. So are we allowed, let's say, to offset interest revenue with interest cost that we incurred because of that money borrowed? So the answer is yes, of course. So IFRSs allow businesses to what? To offset, meaning, or they are really required, not only allowed, but they are required to offset, meaning what? If you, for example, you have an interest expense or your interest cost on that specific borrowing money of $150,000, for example, and you earned $50,000 of interest revenues. So what you are allowed to capitalize, not the entire 150, but the difference, meaning 150 less 50, that's how to just capitalize the net amount of interest cost. Because from one side you have interest cost, on another side you have interest revenues, so you should offset both amounts only, of course, when they are earned on specific borrowing note or bond or whatever, that is, meaning this money that is specifically borrowed to finance that discrete project or that building or that construction, okay? So this is also, let's say, a rational way of dealing with this interest costs and interest revenues, okay? You cannot really be able to consider all the interest cost if you are making also revenues for, over investment of that specific money, okay? Bahi, is that clear, please, regarding the capitalization issues, all of this stuff? So you have, please, to just keep in mind what will be the different steps to measure, first of all, the interest cost, the avoidable, meaning interest expense, and also compare it, of course, to the actual interest expense, and just pick the lower between them to be capitalized as a part of the cost of the construction of the equipment, maybe machinery, etc. Okay. Any question, please, before we move on to another issue here? It's about the valuation.
Miss, I have a question.
Yes, go ahead, madam, please.
Miss, I didn't understand the first point where we said that we should capitalize the interest based on the use of the land instead of the use of the loan. Why did we do that?
Here we're talking about the situation when, for example, you will be, you need, of course, you borrow money to make a project, construction, etc., building, etc. And of course, to be able to, I don't know, to realize, to build that specific building or construction, you need beforehand to purchase the land, okay? So in this situation, the question was, if I'm purchasing land, of course, with this money borrowed, with the intention, of course, to build something over that land, should I consider the interest amount, of course, to be capitalized as a part of the land cost or the building cost? That's the question, okay? So here the answer is that, as I said, if we purchase specifically this land with this, of course, intention to build construction over that land, so the land will be serving as a site or as a plant for that building, okay? In this situation, the interest to be capitalized will be part of the cost of the building, not the cost of the land. You see?
Yes, miss, but what if the loan was for buying the land, not for the...
Yes.
So it's an expenditure on the land.
Yes. So this is the second here, the second situation. So if you have borrowed money with this, let's say, objective to what? To purchase land, but to develop that land, you make maybe improvement to that land, you make these loads, all fences is, of course, you add, for example, to that land, etc. You prepared, of course, for this project, and that, of course, will be ready for its intended use, okay? Of course, the interest that you will be incurring over that, of course, money borrowed will be part of the cost of that land, okay? So to make it, please, to put it differently and to make it simple in your mind, you are, of course, you have two projects. Let's assume you have two projects. The first one, you want, for example, you want, let's assume, to make it really a real example, you have a project, for example, to build, I don't know, housing, etc., and of course to be sold later, etc. Let's say housing for students, etc. So you will need really a big part of land where you will build all these apartments and, of course, houses, etc., or these dortoirs, for students. At the same time, you will keep a portion of that land, let's say, to be improve it or develop it into maybe for sports activities. So it will be, for example, for football field or whatever, okay? So we have actually two situations for this land. Part of this land will be used to build something over it, okay? So in this situation, the interest capitalized over, of course, the expenditures that you are making, of course, for that, to finance that, let's say, first part of that project will be what? Will be included in the construction in process or in the building account, okay? So why? Because land was simply needed to build something over. In the other second part of that project, you will have lands to be developed for these sport activities, etc., for students, okay? So obviously there is no construction over that land, but there will be development, there are lands improvement and so on, okay? So the interest, of course, that you will be capitalizing because of the expenditures you are making to make ready this field, of course, for these sport activities will be part of the land cost. So this is what is sought in this special issue here related to interest capitalization. Is that clear, please? Maria,
Yes,
is it okay?
yes. Mm-hmm.
Are you sure?
Yes, I get it, yes.
So simply, please, in the process, when you will be constructing a building or something, etc., you need to purchase a land, okay? So in this, of course, situation, interest expense or capitalized, of course, will be capitalized, should not be included in the land account, should be included in the construction in process or building account. So this is for the first year statement. The next statement is about the situation when you are not developing a construction over that land, and still, of course, you purchased that land to develop it for that project, etc., and then, of course, maybe sell it, etc., or use it for your own, I don't know, needs. Then, of course, the interest cost will be part of the land account. So that's as simple, please, as it is. So don't melt things, but just keep in mind that when you have a construction over a land, interest should be capitalized in the construction account. When you don't have, you are just making improvement to that land and maybe preparing some load, etc., for sales, you will be including the interest cost to the cost of that land. Okay, so that's about the interest capitalization issue for the self-constructed assets. Okay, so this next learning objective will be talking about the evaluation of the property, plant, and equipment. Okay, so here this is just let's say an introduction to what we'll be talking about when we have an exchange of assets with another asset, but of course with non-monetary asset. Okay, yani when we exchange asset with another asset, of course, other than money. Okay, so that's important. That's important for the valuation issue. Okay. So in general, we used, of course, to report and record property, plant, and equipment at which what? At the fair value of what you give up. Remember, when you purchase a fixed asset, yeah, you give up in general money, and this is, of course, the cost of that asset, remember, and that's the fair value of what we give up. So that's the general situation when there is no problem of course, knowing the fair value of what we give up. If, of course, we are in situation that we cannot really clearly identify the fair value of what we give up, then we should what? Consider the fair value of the asset received, okay? Of what we maybe purchased. You see the difference? So please, the general rule is that if we be purchasing or maybe, I don't know, getting, of course, another asset, maybe exchange it against another property, plant, and equipment here, we should first record that asset received at the fair value of what we give up or the fair value of what we received, whichever, of course, is clearly more clearly evident. So here, if it is more evident or if it is more reliable, the fair value of what you give up, that's okay. That's the general situation. If we are not in that possibility to identify the fair value of what we give up, then we should consider the fair value of the asset that we received. Okay, so we see examples, of course, on how to apply that that valuation here rule. As I said, in particular, when you are dealing with this exchange of assets with non-monetary assets. Okay. Okay, so here this is, of course, as I said, the general rule about, of course, evaluating in general the property, plant, and equipment. So as I said in the beginning, when we purchase, we can, of course, give up money. So we should record them at the fair value of what we give up, at the fair value of that money. Of course, if we maybe give up other than money and we are not, it's not possible for us to identify the fair value of what we gave up, then we should consider the fair value of what we received, of course, in terms of asset. Okay, so that's as I said, the general situations, but this situation may be complicated when you have, for example, cash discount. So if, for example, you purchase an asset and you are offered a cash discount for prompt payment, so what will be, let's say, the way of dealing or taking into consideration that cash discount? So imagine you purchase, I don't know, a land. The cost of land is $100,000, and let's assume that the seller decided to offer you 5%, for example, of discount if you will be paying, for example, the amount of land within, for example, the 1 month, for example, of that transaction. Should I, in this situation, should I consider the entire $100,000 as a cost of land, or should I just reduce the cost of land by the amount of the discount by 5%, meaning, of course, this $5,000, so it will be 95. So what do you think? Should I, of course, in situation when I decide as a buyer to benefit from that discount, so should I record, for example, the land purchased at 100,000 or at 95? What do you think? Try to guess.
I say 95.
Why 95?
Because that's
yes, so this is what we will be giving up actually, okay? So if we will be paying 95, so that will be the cost of my land, okay? Otherwise, if I don't consider the cash discount that I was offered by the seller, I will be inflating the cost of that asset, okay? So the general maybe treatment for that situation is that we will consider, of course, this cash discount, so as a deduction from the cost of that asset, but in the situation that when we fail to take that discount, we didn't take it, we should actually what? Consider that as a loss. Consider that as a loss over, of course, that discount offered. Why? Because, just take a look at, I'm not receiving some notification. I'm not sure what it is about. Okay. Go back to the presentation. So please, so when we are offered the cash discount, you should, of course, take that into consideration when evaluating the asset, meaning the asset should be reported at its cost, okay? It should be, the cash discount should be reducing the cost of that asset, because otherwise you will be inflating the asset value, okay? The next situation when you have deferred payment contracts. So assume that you made a purchase of that asset on a long-term credit contract, okay? So you, for example, you'll be paying this purchased asset on installment basis. For example, you'll be paying over years. Every year, of course, you will pay a portion from that asset cost, okay? So what will be then the value of that asset? So, and when I purchase that asset, for example, on January 1st, and of course I will be paying off the cost of that asset, for example, over 3 years to the seller. So should I just wait until the end of the years and then, of course, just sum up all all the expenditures that I made, and then, of course, record the asset at the end of the 3rd year? Or should I, of course, record the asset, of course, at the date the contract was, of course, signed? We have this legal title that was transferred, and all of this, of course, legal procedure. So, of course, when I have, of course, the ownership here changed from, of course, the seller to the buyer. So here I have the legal title, I have the physical possession of that asset, I will enjoy all the rewards, so meaning I will be using that asset, and I will be making benefit from the use of that asset. At the same time, I will incur all the risk of using that asset. So at that moment, of course, I should record it in my accounting books, okay? So the question, what will be the cost to record it? So here is given actually the answer. We should what? Use the present value of the consideration exchanged. So we will measure the present value of the total amount of cost that we are making to the seller here on an installment basis, okay? So we will just measure the present value on discounted, of course, present value using the borrowing rate here, explicitly, of course, mentioned by the two contractors, or that is obviously, of course, the borrowing rate available on the market. Okay, so we'll be using, as I said, the present value to record that asset. Okay. The other situation will be when you make a lump sum purchase. Okay, so remember the lump sum purchase, when we call it also basket purchase, when you purchase many items. Now we know it when we dealt with the inventory. So you purchase different items or different assets, and you pay a global amount for that purchase. Okay, so the question is that if I have, for example, purchased land and construction and, I don't know, equipment from that, let's say, bankrupt firm, with this lump sum purchase of $1,500,000. So this is, of course, the fair value of what I gave up. But the question is, what will be, let's say, the value, or the by which value will be recording the land, the construction, the equipment in my books. Okay, so the answer will be to what? To allocate the total cost among the various assets on the basis of their relative fair market value. So remember what we did in the inventories. When you have different loads, and you will be allocating the cost of this inventories purchased, these loads of land purchased, based on their what? Relative standalone market values. Okay, so you try to identify for every here asset its market value, and then you have, of course, the entire market value. You'll just divide every asset market value over the entire here market value of all the asset, and just multiply this with what? With the cost, the cost of that transaction, to have what the cost of every asset here, separated, of course, from the other one. Okay, so that's for the lump sum purchases, and as I said, it's not different from what we already learned regarding the purchase of inventories on a lump sum also purchase. Okay, the last tier issue is also when you purchase an asset, and of course you'll have, for example, this asset, and in exchange, of course, of what? Of issuance of shares. For example, I may let's say, decided to be part of that business, so I'll be shareholder. So I will what? I'll make I will just I have, for example, I don't know, some of the asset, of course, building, land, constructions, etc., and I will be giving this, of course, asset to the business, of course, as a part of the asset section of that firm. Okay, and of course, in exchange, I will be receiving, of course, shares. Okay, so what will be the value of what I gave to the firm at this level, or of course what was acquired by the business in exchange of this issuance of shares? So now remember, the general rule is that will be what? Considering the fair value of what we give up. So as a firm, I will be giving up what? Shares. Okay, so I'll be trying to identify the fair value of these shares. Okay, and of course, if I am an active of course, I'm a listed firm on an active capital market, etc., it is easy for me to know the fair market value of my shares. Okay, otherwise, if it is not possible, then I should what? Try to identify the fair value of the assets received. Okay, is that clear, please?
Yes.
Okay, Bahi. So this was about the general, as I said, basis for evaluating the property, plant, and equipment. So please, again, the general rule is that we should refer or use the fair value of what we given up, of course, to value the asset received. In case it is not possible, we should go and use the fair value of what we received, the asset received. Okay. We just talked about the specific situations when you give up, for example, just lastly the issuance of shares, or when you will give up, of course, on installment basis, so we'll be using the present value, or when you will give up and you will benefit money and you will benefit from a cash discount also. So all of the stuff we already discussed. Now in particular we'll be talking about a specific situation when you just make an exchange of asset with another asset with the same nature. Meaning what? When, for example, you, I don't know, you exchange a truck with another truck, okay? Or you exchange an equipment, I don't know, furniture, etc., with another similar, of course, equipment, okay? So this is what we qualify as exchanges of non-monetary assets, okay? So here we should actually pay attention, of course, to how to deal, of course, on accounting basis with this situation. And because this is kind of frequent situation or frequent transaction for businesses, okay? So the general rule will apply also to that exchanges, but you will see that you have specific accounting treatment to do when it is about the commercial substance, etc. Okay, so we'll discuss that just after that slide. Okay, so as we said, in general, we should account for any exchange of non-monetary assets. So meaning what? I will, for example, get a new car instead of the old one, or I will get a new machinery instead of the old one that I had. Okay, so that's what we call an exchange of non-monetary asset, meaning that you receive as an exchange or as a replacement of your asset, another asset. So it's not kind of money or whatever. So here it's not money. Here we're talking about property, plant, and equipment. Okay. So again, the general rule will apply. Okay. So we'll be evaluating, of course, the new asset that I got from that exchange transaction based on what? Based on the fair value of what I give up, or also the fair value of the asset received, whichever, of course, is clearly more evident or more, let's say, reliable or possible, of course, to identify and measure. The issue here is that when you exchange an asset with another one, of course, in the same here nature of asset, more likely, of course, the plant or fixed assets, okay? You may incur gains or losses on that exchange, okay? And recognizing gains or losses is only conditioned on the situation that this transaction, what we call, has commercial substance. But before discussing this commercial substance, why talking about gains and losses in that kind of exchanges? You know, when you exchange an asset, this asset that you had it, for example, for, I don't know, you have been using that asset over 4 or 5 years. So it has a book value of that amount, okay? At the same time, so you will exchange, for example, that asset of book value, let's say, of $20,000 with a new, let's say another asset. It can be not new, of course, with another asset that is, of course, valued with its fair value, for example, at $25,000, okay? So you give up an asset with a book value of 20 to receive another with the fair value of 25, okay? At the same time, your old asset has, for example, a fair value of, let's say, $18,000, okay? So in this situation, you have an asset with the book value of 20, its fair value of 18, and you are receiving, of course, another asset of $25,000, for example, and you may be making also extra payment, of course, of money for that exchange. Okay, so the situation here is that why talking about gains or losses? Because you may, I don't know, give up your asset, considering, of course, its book value, while its fair value is higher than the book value, or it is lower. So in case your book value is higher than its fair value, so this situation you are making a gain. And هنا نحكي please at this regarding the same asset given up, okay? So we are only considering the asset given up. When we are talking about gains or losses, it's about the asset that we had and we are intending, of course, to change, okay? So we will compare the fair value of that asset currently at this transaction, at the exchange of cost transaction. What is the fair value of what I give up and what is its book value? So if the book value is lower than its fair value, so at this situation, of course, we are incurring losses. So that's the general situation for that asset. But recognizing or not, meaning recognizing place in accounting, so this is meaning that we should record it, we should journalize that gain or losses. So here companies will or should recognize immediately these gains or losses when, of course, on the exchange, of course, when the transaction has commercial substance. So this is the only condition when you are allowed to immediately, or you are asked immediately to recognize the gains or losses, okay? So what do you mean by exchange with commercial substance, okay? So simply put here, when you have that exchange that is likely to what? To make your future cash flow change as a result of that transaction. You may, for example, have that new asset, as I said, let's say more performant. It will be, for example, increase your cash flows, you'll increase, for example, your production capacity, etc. Okay, so the situation when you make that exchange, and because of that exchange, your future cash flow will also change of that result of that transaction. The result or the change can be, of course, positive or negative, okay? But in both situations, there is a change, okay? So here, if the two parties had that effect or the economic position changed, then we consider that transaction having a commercial substance, okay? So simply a transaction with a commercial substance, meaning a transaction that is likely to change the financial position and the future cash flow of that, of course, both parties in that transaction, okay? So, as I said, the accounting treatment for that exchange, of course, in addition to recognizing the new asset based on the fair value of what you give up or the fair value of what we received, whichever is evident, we should not omit the situation when I may record or realize a gain or losses, only, of course, in situation when I have transactions or exchange that having commercial substance, okay? So if this exchange is lacking commercial substance, meaning what? You got another asset, of course, or a replacement for the old one, and you are this, even though, of course, or despite that exchange, there is no change in your future cash flow. There is no, for example, increase in your productivity level, in your performance, etc. Okay, you keep the same level. There is no substantial here change in your financial position or in your economic position. Okay, so in this situation, if this exchange is lacking commercial substance, we are not allowed to recognize any gain or losses. It will be deferred until what? Until we sell the new asset. Okay. So we'll illustrate, of course, the situation of exchanges with commercial substance, of course, and we'll see both situations when you are incurring losses and also when you are making gains, okay? So remember, companies should recognize a loss if the exchange has commercial substance, okay? So why, of course, should be recognizing that loss? Because, as we said, the asset should not be valued at more than their cash equivalent price. So if we are not recognizing this loss, then we will be overstating our asset, okay? So we will just illustrate with this example. We have this information processing PA that trades its used machine for a new model, a G-Road business solution. The exchange has commercial substance, okay? So here we have used machine for a new model of that machines, and it said that this exchange has commercial substance. And then we had the information regarding the used machine. So it's a book value of 8,000. Now we have the original cost and the accumulated depreciation. So now how to measure book value. That's the cost, original cost less the accumulated depreciation. We have our book value of that asset. And we have also the fair value of that asset at that moment. It is $6,000. And then it said that the new model list for 16. So J-Road gives information processing a trading allowance of 9,000 for the used machine. Information processing computes the cost of the new asset. So here the first thing is that we should what? Identify the cost of the new machine, because we'll be recording this new machine at cost, okay? And of course it should be what? Based on what we give up or what we received, okay? So here, what we give up here is how much, of course, cash payment due, okay? So remember, the value of that, or what is said here, the new machine, the new model list for 16,000, okay? And because of that, I already gave up the old machine, so I got this trading allowance, so reduction of 9,000. So I'm asked from the seller here to make a cash payment of 7,000, in addition, of course, of the old machine that I will give up, okay? So what will be the fair value of what I give up? So in this situation, remember, what I give up is an old machine plus $7,000 of cash. So the fair value of the used machine here, it said it is 6,000 plus the 7,000. That's the cash that I made. So the cost of the new machine will be 13,000 euro. You see here, please. So always remember that we should value property, plant, and equipment in either situation, whether purchase it or exchange it, at what? At the fair value of what we give up. So just try to here guess what we gave up. So in this example, it said that we have, let's say the cost of that new model is 16, or the price, the selling price is 16. But I'm offered that 9,000 of trading allowance because what? Because I'm also getting or giving up an old machine. So what I'm required to pay as cash here is 7,000, in addition to the fair value of the used machine, which is 6,000. So the entire amount that I'm giving up, the fair value of what I give up here is the 13,000, and that's the basis for what? For recording the new machine in my books. Is that clear, please?
Miss, I still don't understand the allowance.
To make it simple, you are purchasing a new machine. مش حتى new machine. Just take the example that's frequent transactions, in particular in Europe. مش في تونس احنا c'est rare. You are just a particular consumer. You have an old car, and you want to purchase a new one. Okay. And you just go to the one of the car agencies, etc., or car seller, and so on, and you just negotiate the situation that you will take over your old car, in exchange, of course, of the new one that you are desiring, of course, to purchase, and you will be paying the difference between the fair value of the new car and the fair value of the old car. You see? So what do you know by the trading allowance? So meaning here you are offered, in this example, by the car here seller, a reduction because he is taking over the old car from you. Yani the new car, for example, is valued at $50,000, and your old one is $20,000. For example, he agreed that you will be paying. You have a trading allowance for 15,000, because he is taking over, as I said, the old car. So you will have to pay not the entire 50,000. You'll be paying $35,000 and also giving up your old car.
Yes, I get it now. So the trading allowance is the difference that we're gonna pay.
The trading here reduction regarding the price of that machine, or of that, of course, asset that you are purchasing. Okay, you are offered an important reduction because you are giving up or giving, of course, or just exchanging, of course, an old asset with this new one. Donc, انت you are, as I said, purchasing another example when you can just exchange it. حتى نحكي, for example, there are some firms that they agree to what? To get back your old, for example, PCs or laptops, and of course you will get a new one. Of course, ما تصيرش transaction directly, the new one will be costing $2,000. And of course الاورد نتاعك بدات حتى $500 ما يغلط لهمش. So the seller here, of course, to encourage such transactions, يقول لك you will give me up, of course you will just abandon, you will give me your old laptop, you will receive the new one that is of course costing its fair value of 2,000, but you won't pay of course the entire 2,000. You will be, for example, getting a trade-in allowance, for example, of $700. So you will have to pay me $1,300 in addition, of course, to your old laptop. You see? So that's the trade-in allowance. That's a reduction regarding the selling price of that asset, knowing or given the situation that you are also giving up an old asset of yours. Okay?
Yes, thank you.
Are you sure? Please, Mariam, I can't do it again. It's not clear.
No, it's okay.
Donc, pour faire plus simple, يعني انت كي باش تشري تو هنا في this case, you are purchasing a new machine, okay? A new machine, هو راهو يعني احنا we are rational consumers ولا حتى investors ولا businessmen, etc. So is it, for example, rational that I will give you a new machine that is of 16, for example, in this case, against an old machine اللي هي متاعك تسوى 6,000 ما غير ما ناخذ عليك حتى شيء. You may tell me that you can receive 16 less 6 here 10,000. And of course, I'm trying not, let's say, to encourage this kind of transactions, etc. Donc نقول لك يا سيدي ناخذ عليك the old machine متاعك خاطر of course I have my ways to maybe improve them and sell them again. Donc ناخذ ما عندك, I will get back of course your old machine. You get the new one. Of course you won't be paying the entire price of the new one. You will be just paying, for example, in this case, you will be paying only 7,000. So I will make a reduction of 9,000 for you. Reduction over the selling price of that new machine. Okay? علاش؟ على خاطر I'm receiving a portion of cash in addition to your old machine.
I don't think.
Clear or not?
Yes.
تمشي تبدل كرهبتك باغ اكزومبل, تمشي معشنه, تمشي لليزينغ يا سيدي ولا نامبورت, ولا معشنه لي زاجونس نتاع النقل باغ اكزومبل الطوموبيل. عملتها هذول ديرنييرمون, عملتها النقل الطوموبيل. النقل الطوموبيل اللي عندك ان بولو ولا عندك ان غولف, ان اونسيان غولف, داكوغ, وتحب تشري نوفيل غولف. باهي نوفيل غولف نعيش في 70 مليون, سومه جديده 70 مليون, وكرهبتك تسوى 30 مليون, داكوغ. الفرق بين لي دو فالور هنا هو باش ياخذ بيان سور الفالور نتاع 30 مليون نتاعك الكهرباء هذيك, بيان سور تو يحسن فيها anyway the business here ولا the agency etc. They have of course their reasons of course to take over this kind of old machines or asset etc. Donc يجمو bien sûr they improve it, they manage of course to sell it back of course at higher prices. Donc باش ياخذوا they will take back كهرباء ما عندك 30 مليون وش يعطيوك واحده ب 70 مليون. باهي انت شنو الانتيغي في الترانزاكشن هذيك؟ انت باش تدفع هكا ولا هكا ل 40 مليون, ما تنجم تبيعها وحدك 30 مليون وتكمل تدفع ل 40 مليون. دونك يقول لك هو باش يشجعك انك تتعامل مع هو باغ اكزومبل النقل الطوموبيل, يقول لك باهي هي الجديده توصل 70 مليون, داكوغ, نطيح لك 10 ملايين في السومه 60 مليون, داكوغ, 60 مليون. دونك انت باش تدفع لهم كيكو سورت ولا دونك 60 مليون, داكوغ, ولا بون اقل شويه يزيد طيح لك 20 مليون بارابور الاخرى. دونك طيح لك 20 مليون, دونك باش تدفع لي انت 40 مليون وبلس تعطيني كرهبتك القديمه. So that's the transaction, how it, of course, it is happening when we have an exchange, of course, of any of these stuffs. Okay, so you will get a new one, of course, in exchange of an old one, but of course, the old one, its fair value is really very low because it is used, it is maybe sometimes it's obsolete, etc. So you will have, of course, to make additional payment of cash. So it is not, of course, advantages, for example, for me, that I will be paying the entire 16. يعني أنا كان باش نخلص, for example, the new machine price 16. نشريها من السوق 16. I don't have to give up my old one. Okay? So I will give up the old one, and giving up the old one will make me benefit from a trading allowance for 9,000, meaning a reduction of the selling price of the new machine. So I'll have to pay only 7,000. So if of course, I should record the transaction. I should record the new machine. So I will debit equipment, but the debiting equipment will be based on which amount. So that's the question. I should what? Identify the fair value of what I give up. So in this example, I give up cash for 7,000. After, of course, reducing the price with the trading allowance. And I give up an old machine with the fair value of 6,000. So I give up as a whole 13,000 euro, and that will be the basis for recording, of course, equipment, the new equipment one. Okay, so that's the first part of that transaction. The second part is that if I will be recording the new machine, and at the same time I will be taking off from my books the old one, okay, and taking off the old one, disposal of the old one, will have, of course, to record any gain or losses, in particular here for this situation, because we have a commercial transaction with commercial substance. Okay, so how to tell if this transaction is making gain or losses? So I should, as I said, remember, compare the book value of what I give up, the used machine in this example, with the fair value of all of the same here used machine. Okay, so in this example we have a book value of 8,000 and we have a fair value of 6,000. So you see here we are making a loss on disposal of that used machine because I gave up a machine that is valued on my books with 8,000 at 6,000. You see here, so I made a loss on the disposal of that used machine by 2,000. Okay, so when you have a book value that is higher than its fair value, you have a loss. When the book value is lower than the fair value, so you are making gain. Okay, so as I said, the second part of that transaction should be recording, taking off, of course, the old machine from my books, and recording or recognizing any gain or loss. So in this transaction we have the loss, so this will be the journal entry. So please do you know how to take off any, let's say, or when you dispose of one of your assets, you know how to take it off from your books. It was normally it should have been taught chapter 9, I guess, in freshman level. Knowing that you didn't get it, most of you, I think. So when we have to dispose of the used asset, and we will have to discuss it in detail in chapter 11, you should take off the accumulated depreciation, and you should take off the old machine based on its original cost. Okay, so we'll debit accumulated depreciation, we'll credit, for example, the equipment with its original cost, and we'll be recording the loss or the gain. Okay, so you see here, first of all, we'll debit the new here equipment at 13. That's what we gave up, the fair value of what we gave up. We will record also the accumulated depreciation. So here we debit this account to, let's say, to close it, because it is about the accumulated depreciation of the old machine here, all the old equipment. So here we have the 4,000 of accumulated depreciation. What else? We have loss on the disposal of that equipment. Remember, we incurred a loss. Why? Because the book value is higher than its fair value. And then, of course, we should take off, so we should credit the old here equipment based on its cost. So original cost, it is 12. And then we have, of course, also paid cash for 7,000. Okay, so that's, of course, the journal entry for that exchange in particular with this commercial substance, because here we are allowed, or we should recognize this loss on the disposal. Okay, so please, so that's let's say it's not a simple journal entry. Okay, so it is let's say complicated one. Why? Because you have this multi account that you'll be using. So don't forget that you should recognize the new one, and at the same time you should account for the disposal of the old one. So how, when we dispose of the old one, we should take off, excuse me, so we should take off the accumulated depreciation by, of course, debiting that account. We should also record the gain or loss. If it is loss, of course, should be debited. If it is gain, we should be crediting that. We should also take off the old equipment from our account based on its original cost, which is 12. And of course, here for that transaction, we paid this difference between the trading allowance and the selling price of that new equipment, which is $7,000. That's how we record that example of exchange. Do you have any question, please? I'm asking.
I think
Are you
it's
there?
yes.
فما كان مريم جوفية. وينهم the others, please?
No, it's clear, Professor.
عايش.
مادام فما في الكومنتس في الشات يا ربي.
لا ما شفت شيء في الشات. هاي all clear. سيرين هكا وقالت لي all clear. باهي. Je vois que vous n'êtes pas nombreux. حتى online, vous n'êtes pas nombreux. Anyway. Just to go back to the chapter. So this is the situation when you have a loss. We'll see now if you have a gain. So the situation here, as we said, we only recognize gain or losses when we only have transactions with commercial substance. So we continue, excuse me, with the same example, but here we're assuming we'll have a gain, okay? So this is the situation for the interstate transportation company that exchanged a number of user trucks plus cash for semi-truck. You see here, you have user trucks that you exchanged for semi-truck, and of course, we will be paying also cash, okay? So the user trucks have a combined book value of 42,000. So the original cost is 64 less 22 accumulated depreciation. The interstate purchasing agent experienced in the second-hand market indicates that the used trucks have a fair value market of 49,000. In addition to the trucks, interstate may pay 11 cash for the semi-truck. Interstate compute the cost of the semi-trucks as follows. So here the thing, you have, first of all, please always just try to proceed in this way. This is a transaction in two steps, okay? So the first step, or the first, of course, measurement that you should do is that you should identify the fair value of what we give up to recognize actually this semi-truck here that was exchanged for this used trucks and cash, okay? So what I give up to get this semi-truck, of course, the fair value of what I give up. So I give up, the most obvious here, I give up 11,000 of cash, okay? And also I give up trucks with a market value of 49. So here, that's the fair value of what I give up, okay? So that's the cost of my semi-truck, which is $60,000, okay? So if I will be recording the semi-truck, the new ones, of course, should be based on the $60,000. So the second here step in this transaction, I should see if I had gain or loss because of giving up, of course, these trucks, the old ones, okay? So to know if I give up these older trucks and I made gain or loss, I should compare the fair value of the older trucks with their, I stress this there, okay? So here we're talking about what we give up. Okay, so the exchange meaning. Okay, so the user track their fair value and also their book value. Okay, so how do we know the user the fair value? So it's already given in this example. We have a fair value 49. It should be compared with what? With their book value. The book value is 42, also given. So here we have what we give up user tracks with book value that is lower than their fair value. Okay, meaning that we are making a gain on the disposal of that by $7,000. Okay, so all this information will be used to compute or to make the journal entry. Okay, so again, will be this journal entry will be what will be recording the new track and also taking off the old ones. Okay, so the semi-track will be recorded at this fair value of what we give up, so that's the cost identified as 60. At the same time, now we should take off. If we take off the old one, we should what? Debit accumulated depreciation here for 22,000. We will credit the user tracks here for 64. Don't forget that we made payment of cash. We already recorded again here. We measured that at 7,000, and also we made the payment of cash for 11,000. Okay, so that's how we record the gain when, of course, we have that exchange with commercial substance. Okay, so please, in general, we should value property, plant, equipment at the fair value of what we give up. Okay, and that's in particular, of course, valuable when we have to deal with this exchange of asset. Of course, exchange with another same, of course, type of asset. It can be, of course, it cannot be money. We are discussing, of course, here the situation when you exchange a machine with another machine, and equipment with another equipment, a building with another one, etc. Okay, so this is, of course, what raises here these issues that we should figure out what will be the cost of that new asset that I received. So to know what is the fair value of what I received, I should measure the fair value of what I gave up. Okay, so, and of course, some examples, you give up old machines, you give up also old machines, of course, so you know the fair value, and also you give up cash. Okay, so the total, of course, will make the cost of your new here asset. Okay, at the same time, the disposal of this old asset will make you incur gains or losses, and recognizing gains or losses depends on whether the transaction has a commercial substance or not. So if it has a commercial substance, you should immediately recognize these gains or losses. If it is not, then you should defer their recognition. Okay, and here we go with this lacking commercial substance transaction. Okay, now assuming that this interstate transportation company exchanges here lacking commercial substance. So the exchange of the semi-truck with of the old trucks with the new one, with the semi-truck, it has no commercial substance, meaning that the semi-truck won't really make a change in my cash flows, or of course in the cash flow of the other parties, etc. Okay, so here we got, if you keep using, of course, this example of gain of 7,000, should not be recorded as a gain. It should be deferred. Then, of course, the basis of recording the new semi-truck will be reduced by this amount of gain. Okay, so here, instead of recording the new semi-truck at 60, it will be recorded at 53. Okay, you see here, so will be in this way. So we'll be debiting the same, of course, account, but the difference is that you won't find the gain on the disposal, and also the cost of the truck, the semi-truck, will be different. Okay, it will be reducing by 7,000. Okay, so you will keep the accumulated depreciation and also the truck used and the cash. Okay, so just keep in mind that you have in situation when you have exchanges with non-monetary exchange of non-monetary assets, excuse me, but with no commercial substance, you will be evaluating your new asset based on what? Based not on the fair value of the what you give up here, the used asset, but based on their book value plus also the cash. Okay, so that's the easiest way to measure the cost of the new asset. Okay, So please keep in mind that when there is no commercial substance, you should only consider the book value of the user tracks plus the cash paid. In this example, you'll have the $53,000 as cost for that semi-tracks. Okay.
Madam?
Yes, please.
Right here we saw that we're seeing a case of a gain. We added to the we deducted from the value of the semi-truck.
Yes.
If we had a loss, do we add it?
Yes, that's a good question here. Yes, we should defer the loss. So we should consider, of course, the fair value. This will be 16.
So for first example where we had a loss,
Yes.
if we didn't have the commercial substance, we add the loss to the value of the new machine.
لا ما قلتش we add. If you go back here, please. We need the loss. Yes. So in this situation, if we are measuring the equipment here value, it will be what? It will be the fair value of what we give up. Okay, قلنا the fair value, but instead, of course, of the fair value of the used machine, we'll be using its book value. Okay, so the book value is 8,000, and here we have a cash payment of 7. So here we'll be making 15,000. So equipment will be 15,000. Accumulated depreciation equipment is the same. There is no loss. And then, of course, equipment for 12 and cash for 7. You see?
Yes, Professor, it's clear. That's what I was asking. Like the equipment will be
yes,
recorded.
because and please, I got your question, and I just wanted to stress that you should, if you just take a look at this explanation, and I prefer always that you, when you have this lacking commercial substance, you always refer when you are measuring the basis for evaluating the new assets, not on the fair value of what you give up here for this user track, but on their book value. That's why ما حبيتش ندخلكم بعضكم باش نقول لك الجين تنحيه واللاس ترجعوا، دونك باش تقول لي كيفاش اللاس ندخلوا نزيدوا. Okay, donc that's why I just stressed this second here explanation is that you refer when it is lacking commercial substance, you should defer any recognition of any gains or losses. Meaning what? You just not consider the fair value of what you give up. Of course, here the part of what you give up, the used assets. So you just need to consider their book value. Okay, so your book value, of course, added. If there is also any cash given up, you should add it, and then you have the basis for estimating the new asset. Okay, that's of course
clear, Professor.
Yes, thank you. That's how, of course, it is easier for you to remember. Okay, because هنا when نحكيو على deferred, let's say method, just keep in mind that when you have to gain to be deferred, it should be reducing the fair value, the entire, of course, fair value that you already measured. If you are, of course, deferring loss, it will be included again, so it will be increasing the fair value of the semi-truck. Okay, so that's how we deal with this exchange. Okay, so in general, please, when we have an exchange of non-monetary asset, as we said, the question here, we have two questions to answer. Okay, we have two, let's say, issues to pay attention when recording or when generalizing that transaction. The first thing is that I will be receiving a new asset. So on which basis I will be valuing this new asset? Actually, you should consider in general this rule of what? Identifying the fair value of what we give up. If it is not possible, we should consider what we received, the fair value of what we received. Okay. Then, of course, this is, of course, the first situation, or the new equipment. We have also another situation because we receive a new one, but at the same time we will give up another old asset. So giving up this old asset, disposal of that old asset will have actually consequences. So it can have a gain or losses, but these gain or losses cannot be recorded and considered in my journal entries if there is no commercial substance in this transaction. Okay, so if there is a commercial substance, we should recognize the entire gain or loss. Okay, if there is no commercial substance, no gain or loss will be recognized until until when? Of course, if I will be selling the new, let's say, the new asset, then of course gain or losses will be recognized without, of course, taking into consideration this issue of lacking commercial substance. Okay. So in addition to that journal entry that will be, of course, informing about that exchange of non-monetary asset, we should also make additional information, additional disclosure, okay? So we should provide more details about that transactions, okay? So first thing is that we should provide or tell about the nature of the transaction, if it is with commercial substance or not. We should also tell what is the method of accounting for the asset exchange. Am I using, for example, the fair value or the cost, historical cost principle? And also, I should tell if there is any gain or losses recognized on that exchange. Okay, so all the details regarding the asset received and also the asset given up should be provided in the notes disclosure. Okay, but I guess we just to check. So within that chapter, please, this government grants, we will just self-step it down. We won't cover. We don't have really enough time to discuss this issue. Yes, we'll move on quickly to close that chapter before you just take a break and we go back. So we go to this slides 52 when we're talking about quickly about the cost subsequent to the acquisition. Okay, so that's also important to cover. So, you know, when you purchase an asset or you have your asset, the asset under your ownership, and of course you will be using that asset, you will be generating, of course, cash flow from using that asset, you are making advantage of using that asset, etc. Okay, so of course it's often that you will be also making cost or incurring costs subsequent to that acquisition. Okay, so you may, for example, incur maintenance costs when you have, for example, to maintain or repair, or you improve it also. Or for example, if you made, I don't know, initially you purchased the building and then of course you made extension to that building. So this extension, this is a subsequent cost. Okay, if you made improvement, for example, to that building, that's also a subsequent expenditure. So the question here is how to account for these expenditures. After all, I incurred cost subsequent to that acquisition of that asset. Should I, for example, record that cost that I incurred in the same, of course, asset account, or it will be in different account, or should I expense it? So these are the questions that will be really quickly answered in these slides. Okay. So here, the general rule is that we should recognize the cost subsequent to acquisition. So please pay attention to what is said here. As an asset, when the cost can be measured reliably and it is probable that the company will obtain future economic benefits. So the general rule is that any expenditure that we incur subsequent to the acquisition of that asset cannot be recorded as an asset, cannot be capitalized. If we cannot, of course, measure that cost with a reliable, of course, measure, and if there is no probability of future economic benefits that I will be obtaining. So this is just simply telling that this expenditure should what? Should obey to the definition of an asset that we already know it from the conceptual framework. Okay, so if I make an expenditure and this expenditure can be, of course, measured with a reliable way, and because of that expenditure there is a probability that I will obtain future economic benefits, then I can record that cost, that money incurred, as asset. Okay. So when we say future economic benefits, how can I tell? Okay, how can I say if there is this future economic benefits that will be flowing to the company or not? Of course, sometimes it can be in the form of what? Increases in useful life. For example, when you make improvement to your machines, and these machines will make extension of the useful life. So the service life, instead of 10 years, will be 13 or 15 years. Okay, so that's a substantial improvement, and that's that's likely, of course, that I will enjoy the future economic benefits from that expenditure. Okay, it can be also in terms of quantity of product produced. So here talking about increasing the production capacity, for example, of that machine or of that equipment. Okay, it can also improve the quality of the product produced, etc. So that's how we can tell that if there are any future economic benefits or not. Because if there is no future economic benefits, if we cannot reliably measure this cost subsequent to acquisition, then we simply what we do? Can you guess? من أول عام وانا نحكي فيها ونقول راهو في accounting when you incur cost, and of course this is like money out of the business يعني of course now ولا حتى in the future, so outflow economic benefits ولا inflow of economic benefits. Now the situation is that you have either to capitalize or to expense. Yes. So if it is not capitalizing, if it's not considering as an asset, then you should consider as an expense. Okay. So here we have just here illustration of the major type of expenditures that are likely to be done after the acquisition of this asset, and we will see how to account for these major expenditures. Okay, so we can proceed for an addition. So here we say it also extension of an existing asset. Okay, we can also proceed with improvement and replacement. Okay, for example, I can improve, as I said, let's say the performance of an old machine, etc. So I made a replacement, for example, of some component of that machine, which likely, for example, to make increase the production capacity, etc. Okay, so it can be substitution of a better or similar asset for an existing one. If I can also rearrange, for example, some sites, building plants, reorganization, I can move one asset from one location to another. I can also incur some repairs cost. Okay, here we're talking about when we say repairing or maintaining, so meaning that I will maintain the asset in the same conditions of operations. Okay, so here, depending, of course, on this type of expenditure that I'm likely to incur post-acquisition of this asset, I should, of course, proceed either by capitalizing or expensing. So please, just to get to keep the general rule, we will always capitalize the expenditures post acquisition of asset if they are likely to increase the future economic benefits. So here, for example, if we have an additions, and we said that additions will make improvement, because when you have an extension, for example, imagine that you will have an extension in your store house, or so of course your capacity, for example, of storing product, etc., will be increased, and then of course the future cash flows will be higher, and so on. So here, any addition cost will be capitalized in the asset account. So to the same asset account, when you make additions, when you make extension, you should increase the same asset account. Okay, if you are making improvements and replacements, so here be careful to that situation. Here, when we talk about improvement and replacement, as if we are replacing an old asset with a new one. So the accounting treatment will be what? To take off the old asset from our books and to record the new one. So that's how we did with the disposal of the asset. So we will debit the accumulated depreciation, credit the asset account, the old one, of course, with its original cost, record gain or losses because of that disposal, and also capitalize the cost, or debit the expenditure for the new here asset account. Okay, if we are rearranging or reorganizing here, it should be expensed, because here rearranging or reorganizing, it is not likely to improve or increase the future economic benefits. For repairs, so be careful. It can be said that we have this, let's say, ordinary routine repairs. So here it should be expensed, because every, for example, year, every frequency you will have, for example, to maintain and repair your machines, etc., to keep the same level of production, okay? So it will be expansive. But if you make major repairs, meaning that you are improving, for example, the capacity of the machine or the quality of the product, etc., here you should proceed like we did for improvement and replacement, meaning that you should take off the old one, removing the cost and the accumulated depreciation of all old asset, and of course recognizing the gain or losses, and at the same time recognizing the new asset with this cost of major repairs. Okay, that's all here for this cost subsequent. But I will just leave you for 10 minutes. We go back to close that chapter and start with a new one. Okay, so please, we go back at 16 and 15, okay, and quarter. 16 and quarter, please.
Miss,
Yes.
Miss, can you please upload the chapters on UVT platform?
Sure, I will do it now. Okay. Okay.
Okay, thank you.
You're welcome. Okay, hi again.
Hello, Miss.
Hello. So we're gonna just finish this chapter with this more 4 slides before we move on to the next one. So just to continue with this issue of property, plant, and equipment, so the last learning objective, it's about retiring and disposal of property, plant, and equipment. We already just discussed the fact that we dispose of an old asset when we exchange it, etc. But here we can dispose of asset when we sell it, or when we make this involuntary conversion, or when we abandon it. Okay. So what is also need to be said, because we didn't cover in the prior slides, it's about depreciation issue. Okay. So what's about depreciation? So in the prior examples, we had actually the accumulated depreciation, all the amount provided, and of course we just did by debiting the accumulated depreciation and crediting, of course, the old asset by its own cost. Okay, this is how we proceed. But the thing is that like depreciation is not always up to date, or it's not really provided with the up-to-date amount. Meaning what? We record depreciation expense in generally. Let's just check what was the. Okay, hello Siri. So what I'm saying, please, is that in general, we use it to what? To record depreciation expense at the end of every accounting period, okay? And it happens, for example, that we assume that we record the depreciation expense and accumulated depreciation for this kind of asset, December 31, for example, with this amount and so on. And then we decided to dispose by selling, exchanging, or abandoning, etc. The asset on March of the next year. Okay, so here we got actually 3 months of using and of course consuming up this asset. So if we want to make a journal entry for that disposal of that asset on March, for example, 2021, knowing that the last depreciation expense was recorded on December 2020. So first thing is that we should make or take the depreciation expense up to the date of the disposition, meaning what? This 3 months, as I gave the example, for example, for January, February, March, I should first of all record the depreciation expense for this period, of which, of course, I've used the asset after, of course, the last depreciation expense that I recorded at the end of the accounting period of the last year. Okay, so please again, the last depreciation expense every year, we use it to record depreciation expense at December 31 of the year. So assuming it was December 31, 2020. And then we sold the asset on June 2021. So what we do is that we should first of all record the depreciation expense for this 6 months before making the journal entry for the disposal of the asset. Okay, so why, of course, taking up the depreciation to this date of the disposal? It is really normal. It should be done in this way because we use that asset for that period. So the accumulated depreciation should not be only based on the prior period, but also the actual period should be also included. So here we update depreciation expense and also the accumulated depreciation for that asset until the date of the disposal. And why this update is important? Because you know that we should first of all measure the book value of that asset, compare it to its fair value, and then recognize any gain or loss, of course, depending, of course, on the situation, whether the book value is higher or lower than the fair value. So to be able to determine the accurate amount of the book value of that asset, you should not forget, first of all, to update or bring the depreciation expense up to the date of the disposal of that asset. Okay, here we got this example to just close the chapter quickly. So Barrett Group recorded depreciation on a machine costing 18 for 9 years at a rate of 1,200 per year. If it sells the machine in the middle of the 10th year for 7,000, Barrett record depreciation to the date of sales as. You see here, so what is said here? It was, of course, recording the annual depreciation expense for 1,200 over what? Over 9 years. And then within the 10th year here, so in the middle, it was sold, okay? The machine was sold. So here, assuming that it was sold on July, for example, 1st. So we should what? We should record, first of all, the depreciation expense to the date of the sale. So meaning we should record the depreciation expense related to the period from January 1st until June 30th. Okay, so it will be, of course, for half of a year. So we use it to record annual depreciation of 1,200. Then, of course, the depreciation expense will be half. It will be 600. So depreciation expense will be debited and accumulated depreciation will be credited for 600. Okay, so this is, of course, the first, let's say, step to do before accounting for the disposal of that asset by selling this machine. Okay, so the second thing is that we should what? We should, to record the sale of that asset, as we just did in the prior slides, we should first of all compute the book value of that asset, compare it, I mean, of course, to its fair value, and the difference will be recorded as either gain or loss. Okay, so what is the book value of the asset? It should be what? The cost less the accumulated depreciation. So when we have a cost of 18, how much we have accumulated depreciation? So we have 9.5 years of depreciation. Okay, so it should be so here, just making the journal entry quickly. So if it sells machine in the middle of the 10 years for 7,000, so of course we sold it for 7,000, so we debited cash for 7,000. As I said, to take off, to dispose of asset, we should what? We should debit accumulated depreciation. So accumulated depreciation will be for the 9.5. You see here, so 9 times the 1,200, it is of 10,800, and just add the 600, so it is 11,400. So you see here, that's the accumulated depreciation up to the date of the disposal. Okay, what else? So as we said, we should compare the book value with the fair value of that machine. So the book value is 18 less 11,400, so it is 660, and we sold it at 7,000. So here we made a gain of 600. Okay, so here we should take up the machine at its cost, and we should record a gain on the disposal of machine by 400. Okay, so that's how we dispose of one here asset by selling it. Okay, so this is the same way we did when we changed, etc., or when we have, for example, to deal with any, let's say, improvement or replacement of the asset, when we have to account for the cost subsequent to the acquisition of that asset. So there is no difference here, but just what is new is that you should pay attention to the accumulated depreciation. So as I said in the prior slides, you had the accumulated depreciation, assuming it was up to date, okay, up to the date of the disposal. Now, if it is not, of course, you should first of all update the accumulated depreciation by recording the depreciation expense for the period over which it was used until, of course, it was disposed of, and then, of course, proceed with this journal entry. As I said, see if there is any gain or loss, based on what? Based on comparing the book value of the asset with its fair value. Okay. When it is about involuntary conversion, so here when you lose one of your assets, or the asset service is terminated through this incident like fire, flood, or theft, etc. So here we should proceed in the same way. So we should take off the assets from our book. But the thing is that, should I record the gain or loss? So it should be based on what? based on the difference between how much I can recover, for example, and it should be, of course, if I have an insurance policy. So if I recovered an insurance policy, I should compare the amount recovered with the asset book value at the date, of course, of the of this incident, etc., and then record again a loss. Okay. And of course, the same accounting or the same journal entry will be done. Okay, so we'll debit accumulated depreciation, we'll credit, for example, the equipment, and if, for example, we recovered insurance, so we debit cash, and of course, the difference will be recorded as gain or losses. Okay. So here is, we have this example. I should really close that chapter because we are we're being late for covering chapter 11. So this is the situation for Camel Transport Corporation that had to sell a plant located on company property that stood directly in the path of an interstate highway. Camel received 500,000, which substantially exceeded the book value of the land of 150 and the book value of the building of 100. So this is the cost less accumulated depreciation. So here we got what? We have a total book value of land and the building, which is 250. We got 500,000 as, of course, a replacement for this. Okay, so we should take off as we did. So we should debit cash what we received. We have accumulated depreciation of 200 to be debited, and we should, of course, credit the book value, of course, of building here cost 300. So here, of course, should be careful. So the asset should be taken off at cost, at original cost. So 300. We have a land at 150. And of course, the difference will be for gain on disposal of plant asset. Okay, so we made a gain on the disposal of that plant asset. Okay. So you just notice here that the land is not depreciable. So the accumulated depreciation is only about the building. So that's why, of course, we have a gain which is of 250, not the only 200. Okay. Is that clear, please? So just to summarize, when you dispose of assets, you should please, first step, update the depreciation expense so that the accumulated depreciation will be updated. Then the next step, you will be able to measure the book value of the asset, which is what the difference between the original cost and the accumulated depreciation. Why we need to measure the book value? Because we need to know if it is a gain or loss over the transaction. So we should compare the book value with the fair value of that asset at the moment, of course, of the disposal. And if it is, of course, the book value is higher than the fair value, we should record a loss. If it is the opposite, the fair value is higher than the book value, then you should record a gain. Okay? Is that clear?
Yes, miss.
Yes.
Yes.
Okay, good. Do you have any question before we see additional issues regarding actually property, plant, and equipment? So what we covered until now, that's the, let's say, the general rules for valuation, but with the specific situations. Okay. So now we will, and I'm really hesitating about covering the first part of NAD. And we'll just see what I can do. So in this chapter, the important focus is about the impairment of assets, okay? Impairment and in particular revaluation. So I used just to cover these two sections within this chapter. But tell me, do you have an idea about the depreciation methods? What are the different methods of depreciation? How to measure depreciation expense based on these different depreciation methods? Honestly.
Yes, we studied them in financial statement analysis.
Okay, good. So you think that doesn't matter if we don't cover the first section?
Yes, I think it would be okay.
Okay, so depreciation method, you can go just through this section and read it by your own, of course, by yourself, and just go back to me if you have any problem. For the other depreciation issues, so the component depreciation, did you talk about it? Partial periods, and also when we talk about revision of depreciation rates. Just
No.
for the revision of depreciation rates, these are will be covered. Don't worry, in the next semester, normally when we talk about change in accounting methods and estimates. So here we will have it to deal with example of revision of depreciation rates, or changing, for example, the useful life or the salvage value. So these cases will be treated. So it's not a problem that we won't cover today. For component depreciation, so simply here, we'll just talk about it. So for depreciation and replacement, so this is also the situation when we have an exchange or when we dispose. So this is the thing that we already treated, okay? So we don't need actually to repeat this again. To talk, of course, to have enough time to talk about impairment, okay? So simply please put regarding the component depreciation. So what is said here regarding the IFRS, that is allowing businesses to proceed with the component depreciation when we have, for example, imagine that you have, I don't know, you have a building or machines or construction, etc., with identifiable separate component, and these components will have what we call different useful life, so which will make actually a whole depreciation expense is not really accurate, because every component has its own useful life. Imagine that, for example, we have a machine with one component useful life of 20 years, the other is, let's say, 5 years. So it won't make sense, for example, to apply a straight line, for example, rate of let's assume 100 over 20, so 5% for the entire machine, while, for example, for the one of the component of this machine should require 20% of expense of depreciation expense rate, okay? So for that reason, when we are in this situation of component that they are, of course, identifiable and separable within one asset, and this component, they have what? Different useful lives or different also salvage value, etc. They should be what? Accounted for in different or in separate way. Meaning we should proceed for every component, we should measure its own depreciation expense, okay? And then, of course, compute the entire depreciation, the annual depreciation expense based on this component depreciation, okay? So that's just the general rule regarding the component depreciation. We may have another time to discuss it, but just we talk quickly about the so this is about the impairment, not the impairment here, the component depreciation. Just, am I sharing the screen? Not yet, okay. See, I'm sharing my screen, huh? I'm sharing the chapter 11. Okay, good. But, just to go quickly to the impairment. So when we talk about impairment, or what is impairment, okay? So here, of course, we are still covering this property, plant, and equipment section. So the tangible, what we call long-lived tangible assets. So we say this asset, for example, is impaired when what? When we have, when we are in a situation that the business is not able to recover the asset carrying amount, either through using it or by selling it, okay? So just to put it in a simple way, so we're talking about, let's say, losing value of that asset. So that's what we call impairment, okay? The loss of value. And why this loss of value? How can we tell if there is a loss of value of that asset? If I compare its carrying value, meaning the book value of that asset, with what I'm expecting, for example, to collect as future cash flow when I'm using, I will be using, of course, that asset, or what if I compare the fair value that I will be receiving, for example, if I will be, in particular, not the fair value, but the net realizable value, if I will be receiving, if I will sell that asset, and there will be, of course, the book value will be higher than one of this amount. For example, the value in use, this is when I talk about using it, or the net realizable value. So in this situation, I have a loss of value of that asset. And, you know, that's, of course, again, conservatism in accounting. That's, again, a way to not really overstate my assets. Always, I should provide accurate information. If my asset, my book value of the asset will be above what I'm expecting to be the value in use of that asset or the net realizable value of that asset, then I should record that as impairment of that asset. Okay, so we should see what will be the steps to perform in order, of course, to recognize that impairment. Okay, so on annual basis, companies will review the asset for indicators of impairment. So that's, let's say, a routine and, of course, a frequent process. So every year, the firm should what? Should see if they should account for any impairment of their assets. Okay, so they should, let's say, look for any indicator. Okay, it can be, of course, internal indicator or external indicator of the for that impairment. Okay, so again, what is impairment? Decline of the asset cash generating ability through use or sale. Okay, so when we expect that there will be decline in what? In the future economic benefit or in this cash generating ability by selling this asset, meaning what I'm expecting to realize from selling that asset, then I should what? I should record that as impairment. So this accounting treatment is actually similar to what we have seen when we talk about inventory, also impairment. Okay. But here, of course, it is specific here to the property, plant, and equipment, to the tangible assets, okay, long-lived tangible assets. So to be able, of course, here to talk about impairment, we said that we should what? We should look for indicators. So we should every year, let's say, implement this test. Okay, so we should conduct what we call the impairment test. Okay, what is the impairment test? We should, first of all, of course, we have an idea about the carrying amount, which is the book value. So it should be compared to what? To recoverable amount. Okay, and what is the recoverable amount for one asset here? It should be the higher of what? The fair value less cost to sell, which is, of course, the realizable value. So the fair value less cost to sell, or the so the higher between the fair value less cost to sell and the value in use. Okay, so again, what is the value in use? So it can be, of course, the present value, future cash flows that I'm expecting, of course, to generate from using that asset. And the fair value less cost to sell, of course, here, that's the realizable value that I'm expecting, of course, to collect when I will sell that, if I decide, of course, to sell that asset. Okay, so at the end of every accounting period, every firm, if there is any reason to think that there is a possibility of what? Of impairment for their asset, they should proceed with that test. So they should compare the carrying amount with the recoverable amount. What is a recoverable amount? It should be picked as a higher of what? The value in use and the fair value less cost to sell. Okay, so we should compare them. Of course, if the carrying amount is higher than the recoverable amount, then we have impairment. If it is, of course, opposite, so there is no impairment, there is nothing to do. Okay, so let's take this example. Assume that Cruise SA performs an impairment test for its equipment. The carrying amount of Cruise equipment is 200,000. Its fair value less cost to sell is 180, and its value in use is 205. So here we have what? We have a carrying amount of 200. And we have a recoverable amount that should be the higher between 180 and 205, okay? So we should pick the 205. So 205 compared to 200 here. So here, it is higher than the carrying amount, so meaning that there is no impairment in this situation, okay? So that's the first situation. So imagine now if we talk about the value here in use, it is 175 instead of 205. Okay, so the higher will be higher of course will be considered as recoverable amount is 180. So in this situation we have a carrying amount that is higher than the recoverable amount. Okay, what should be, of course, in this situation, we should account for an impairment of 20,000 euro. That's the impairment loss that should be recorded. Okay, so to account for that situation, what we should do, we should debit the impairment loss or loss on impairment here for 20,000. And which account to be credited? Can you guess? So here it should be, of course, yes, accumulated depreciation for equipment. So instead, of course, of recording that, let's say, loss on impairment directly on the asset itself account, we prefer to use the accumulated depreciation account. علاش؟ على خاطر, in fact, this impairment can be reversed. Okay, so it won't be really informative if any, for example, impairment or any recovery of impairment will be directly imputed to the asset account itself. So it will be really providing blurry information regarding what is the original cost, what is the book value, etc. So assume that loss on impairment should be credited, of course, to the accumulated depreciation account. Okay, let's continue with this impairment and let's just see these examples. Because you will see that here when we talk about impairment, that's when we have, as I said, depreciation issues, etc. It will be a little bit complicated. Okay, so December 31, 2020, we have Hanoic that has equipment with a cost of 26 million and accumulated depreciation of 12 million. The equipment has a total useful life of 4 years with a residual value of 2 million. And we have also information relates to this equipment. The equipment carrying amount at December 2020 is 14,000 million. So here, how we measure that, of course, the difference between cost and the accumulated depreciation. It said that the firm is using the straight line depreciation. So the annual depreciation was what? Was 6 million. And is recorded here for 2020. It is already recorded. So how we measured 6 million if we are using the straight line method? So we have what? We have the depreciable cost, which is the cost less the salvage value, over what? Over the useful life. That's how we measure depreciation, annual depreciation expense using the straight line method. Okay. So it is 6 million here as identified and recorded, and it said that Hano determined that the recoverable amount for this asset that December is 11 million. And we have also remaining useful life of the equipment after December 31, that is 2 years. Okay. So here we should first of all test this asset for impairment. So we should always what? Compare the carrying amount with the recoverable amount. Okay. So it said that the carrying amount here, that's the equipment carrying value, it is 14 million. It should be compared to the recoverable amount of 11 million. So here what? We have a carrying amount that is higher than its recoverable amount. So here we have an impairment loss of 3 million. Okay. So we will debit loss on impairment and we'll credit accumulated depreciation for this 3 million. Okay. And that's, of course, the new carrying value. Okay. So we have what? We have 26 as equipment less the new accumulated depreciation, because it was, you see here, the accumulated depreciation was 12. We added 3 million to that accumulated depreciation. So it will be 26 less 15. So we got 11 million as a carrying value. Okay. So we have also that the issue that the total useful life has not changed. So here we have remaining useful life is still 2 years. However, the estimated residual value of the equipment is now 0. And I continue to choose the straight line depreciation and makes the following journal entry to record depreciation for 2021. So the thing here is that what is said, is said that we still have the same useful life of the asset. So still have to compute or record depreciation expense for the 2 remaining useful life here. But the thing is that we have here a change an indicator or an estimate that changed, which is about the residual value. Okay, so now the residual value is 0. So whenever we have actually change in residual value, or maybe change in the useful life, or change in the, let's say, the depreciation rate, we should measure or consider the book value of the asset as its original or its a new cost. Okay, just please one thing, just 1 minute, I need to answer that phone. So as I said, please, again, regarding depreciation expense in general, okay? So if you encounter that situation when you said that you have a change, for example, after a certain period, for example, useful life will be changing. For example, it will be, I don't know, extended or reduced. You have, for example, change in the straight line, for example, of course, rate here when we talk about useful life is changing. You have, for example, different residual value. So what will be, of course, the new depreciation expense? So to be able to compute the new depreciation expense, we should what? Consider the book value of that asset at the date, of course, of that change, like its original cost, and this will be served as what? As the depreciable, of course, base for that asset. Okay, so here what we got? Anna, 11 million, that's the carrying value. So that's, let's say, the depreciable or the original, the new cost of that asset. Okay, it's not the original, but the new cost of that asset. Now, كنحب نحسب depreciation expense for that asset. What we do, the annual depreciation, we should consider this cost, the new cost, I mean, the 11 million, less what? The residual value, in this case, it is 0. And of course, it should be divided by the remaining useful life. That's how, of course, the straight line method will be applied. Okay, so here divided by 2, so we have the annual depreciation expense of 5,500,000. Okay, so we'll debit depreciation expense for that amount, and we credit accumulated depreciation with the same amount. Is that clear?
Yes, miss.
Yes, it's clear.
Okay, good. The second here situation is regarding, of course, computing the value in use here, guys. So at the end of 2019, Verma company tested a machine for impairment. The machine has a carrying amount of 200,000. It has an estimated remaining useful life of 5 years. Because there is little market-related information on which to base a recoverable amount based on fair value, Verma determines that the machine's recoverable amount will be based on value in use. Verma uses a discount rate of 8%. Verma's analysis indicates that its future cash flows will be 40,000 each year for 5 years, and it will receive a residual value of 10,000 at the end of the 5 years. It is assumed that all cash flow occur at the end of the year. So here's the thing, if we are considering, of course, the value in use as a basis for estimating the recoverable amount of that asset, then we should, of course, measure the present. Just excuse me, I will need to pick this phone. I will be back in 2 minutes. Sorry for the interruption. So, as we said here, the recoverable amount will be based on the value in use. And what is the value in use? We should measure the present discounted value of these future cash flows. Okay, so what is said here is that the firm will be receiving over 5 years here, it will be receiving $40 million. But that's, of course, for 5 annual payments. So here, that's the factor, of course, of present value factor. You have the table on chapter 6. We should just go and see for every year for 8% here. You'll get, of course, this factor number, of course, used to measure the present value of this $40,000 that will be received for 5 annual payments. Okay, so that's the present value for the $40,000. for the 5 years, of course, ahead. And of course, in addition to that, it said that we'll be receiving a residual value at the end of the 5th year by 10,000. So here, after 5 years here, that's the one, of course, amount. $10,000 will be, of course, multiplied by this, of course, fair value, present value factor, excuse me. So we got this 6,805 present value of this residual value. So in total, the value in use of that asset, considering the fact that we have the future cash flows over 5 years plus residual value. So we got all of them here discounted based on that discount rate of 8%. So we have the value in use that is 166,514, okay? So this, of course, the value in use that will be compared to the carrying amount. And of course, if the carrying amount is higher than the value in use, then we have an impairment. If it is the opposite, there is nothing to do, okay? So we should compare to 166 and 514. So here we have an impairment of 33,486, okay? So here what we should do then, we should debit the loss on impairment and accumulated depreciation machinery with this amount, okay? Is that clear, please? Okay, I assume it's okay. But next, now, as I said from the beginning, this impairment actually loss cannot be definitive. Okay, we can, for example, recover, market conditions. I don't know, any of the, for example, the factor or indicators of that impairment disappeared. So that, of course, I will be recovering what I before, of course, we called it as a loss. Okay. So here's the example of reversal of that impairment. Okay. So here we're talking about purchase of equipment on January 1st for 300,000. Useful life of 3 years and no residual value. So here we assume that we have what? Equipment that was purchased for 300, that's the cost. We have no residual value. So the depreciation expense over 3 years. So every year will be what? We coding 100,000 as depreciation expense. So the carrying amount will be what? Will be, of course, the cost less the accumulated depreciation. So that's my carrying amount here at the end of every year, 2019, 2020, and 2021, okay? So in 2019 here, we had what? The firm identified and measured an impairment loss of 20,000, okay? So here, they normally, of course, proceed like we already learned. So we debit the loss on impairment and we credit the accumulated depreciation, okay? What else? Then at the end of 2020 here, 10 determines that the recoverable amount of the equipment is 96. So here the thing is that we already had an accumulated depreciation. In addition to the 100, we have also 20, okay? So here 120. So at the end of 2020, we got what? We had 80 or one. So at the end of 2020, we got 220. So 80,000, of course, dollars or Hong Kong dollars here as carrying amount. Okay. 180 over 2. So that's the carrying amount after, of course, reducing. That's 90,000. Okay. So if the firm here is identified that the recoverable amount is 96, okay? So we have a carrying amount of 90 and 96, that's the recoverable amount. So here in this situation, what we got? We got the recoverable amount that is higher than the carrying amount. So remember, please, in the beginning, the first step, when we just proceed with the impairment test and we had the value in use or the recoverable amount in general is higher than the carrying amount, there is nothing to do. There is no impairment. But then we have a recoverable amount that is higher than the carrying amount, but we should proceed with the adjusting entry. We already recorded in the prior period an impairment loss. So my loss was 20,000. Now I have a reversion of 6,000, so I should account for that, okay? So I should debit accumulated depreciation, so undo part of the accumulated depreciation. So from these 20,000, let's say recovered 6,000. Okay, so I will debit accumulated depreciation, and I will credit recovery, of course, of impairment loss by 6,000. Okay, is that clear, please?
Yes.
So Hane, please, Rao, be careful regarding the carrying amount. Rao, you should not consider the carrying amount of 100, okay? علاش؟ على خاطر it said that here at the end of 2019, we had a carrying amount of 200. That's without considering the impairment here issue. But if we have this recorded the loss on impairment, so at the end of 2019, we have what? We have 180 as carrying amount. Okay, so now if we have 180 as carrying amount, this 180 of course will be divided of course by the remaining useful life, so it will be 90,000 and 90,000 as depreciation expense, and of course here will be 90,000 as carrying amount at the end of 2020. Okay, so that's the amount of recovery, the 6,000, because of the difference between 96 and 90,000 dollars. Okay. Well, we just need to disregard this issue. Okay, so let's just talk about this impairment of the assets when we are, of course, about to dispose of that asset. Okay, so you, for example, you had an asset, you recorded the depreciation expense, you made the test for impairment, you recorded the loss, and so on, and then, of course, you decided to dispose of that asset. Okay. So if I am in a situation that when we say the asset to be disposed of, meaning what? To dispose it of, meaning that it is kind of available for sale, kind of that I will be selling, kind of ماهوش كيف but kind of that it is, of course, inventory. Okay, so I should report this impaired asset at the lower of cost of net realizable value. Okay, so that's, of course, the logic behind, of course, inventories. But here we're considering assets to be disposed of as what? As available for sale. So it's no longer really as an asset that I will be continue using in operation. So I will be disposing, I will be selling that asset, so it will be available for sale. And when it is available for sale, then it should be, because of course of its impairment, should be recorded as a lower of cost or net realizable value. Okay, of course, excuse me, علاش قلت it is kind of, or it should be like compare it to inventories, etc. If it is available for sale, so there is no longer use of that asset for my own operation, so there is no reason actually to depreciate it or amortize it. Okay, so here during the period, of course, I'm holding that asset, but I'm counting to dispose of, I'm counting to sell it. So this is what I'm saying, available for sale. I should not depreciate or amortize that asset. Okay, so it's no longer used in my operation, so there is no need to allocate the cost of using that asset over its useful life, which is the definition of the depreciation. So let's, as I said, we will assume it, or we will assimilate it as inventories. Okay, so we can write up, of course, or down an asset held for disposal in future period, as long as the carrying amount after the write-up never exceeds the carrying amount of the asset before the impairment. So again, this is the same thing as we did for inventories. Okay, so we can, of course, if there is a decline in, of course, in the value in use, or the here when we talk about the net realizable value compared, of course, to the carrying amount, then of course we should we should write down, and we can also reverse that write down if there is an increase, for example, in the net realizable value. But be careful, we should not, that increase will be exceeding the asset before the impairment. Okay, so we should just not exceed the original carrying amount. Okay, so this is just an illustration of what we already discussed. Okay, so any firm, if they, of course, have, of course, tangible asset that are used in operations, and let's say they have information, as I said, kind of internal or external information that is indicating that there is a probability of impairment of that asset, then they should proceed to that impairment test. What is impairment test? Should be comparing recoverable amount to the carrying amount. So what is carrying amount? So that's the book value. Recoverable amount, that's the lower, the higher between the value in use and the fair value less cost to sell. So if recoverable amount is less than the carrying amount, then there is no impairment. If, of course, the recoverable amount, actually, yes, the recoverable amount is lower than the carrying amount. So there is, of course, an impairment here, and we should what? We should record that loss on impairment or impairment loss on credit accumulated depreciation in situation, of course, when we have what? The assets that are held for use, okay? So for the asset held for use, meaning that I will continue using this asset for my operation. As I said, I will record impairment loss or loss on impairment. That is the excess of carrying amount over recoverable amount. And then, of course, this actually, the impairment loss will be what? Will be reducing the carrying amount in addition, of course, for this depreciation expense. So we have what? A new basis for measuring the depreciation expense for every year. There is room also to reverse that impairment, so it is permitted, but it will be limited to that initial loss. It should not be exceeding, of course, the original carrying amount before the impairment, okay? That's, of course, in the normal situation when you held this asset for use in operations. But if you are now counting to dispose of that asset, or that asset, it is meant to be sold, okay? So here we're talking about available for sale or held for sale or disposal. So now it's kind of, as I said, it can be assimilated to the inventory situation when you should account for as a lower between cost and lower of cost net realizable value. And of course, there is no depreciation to be accounted for because it is not used in operations, okay? We won't cover the depletion. We'll just move on. I will close that chapter with what? With the revaluation issue, okay? Okay, are you following, please? I know it's heavy in terms of details and information, but we need to cover these issues. And you have seen that I'm really ignoring some parts because they are not really as important as these issues. Is that clear, please, for the impairment?
Yes, it's clear for the impairment.
Okay. So it won't take longer. We will just need to maybe 10 minutes to finish this issue. So now we'll be talking about revaluations. Okay, what do you mean by revaluation? So remember when we have the accounting principle, which are the historical cost principle, measuring, of course, measurement principle. So the historical cost and the fair value measurement principles. Okay, so here, as IFRS, of course, permit, as companies or any business, of course, they may value their long-lived tangible asset, of course, subsequent to acquisition at cost or fair value. What do you mean by subsequent to acquisition? You know, when we purchase an asset, that's actually its fair value, okay? We measure its historical cost based on the fair value of what we give up. If we paid, for example, for money, etc., this amount and so on, we recorded that's the cost of that asset, and we will use that cost of the asset. We have the choice actually over the useful life of that asset. So as long as I'm keeping that asset within my books, I will continue, for example, using the cost of that asset as a way to value that asset, or I can use the fair value. Okay, so I have two possibilities or two alternatives. I can continue using the cost, or I can switch and use the fair value. Okay. So changing, of course, I assume that January 1st, I purchased that land or building, whatever, or equipment, I purchased for $50,000, okay? So December 31, this is, of course, where I should decide. Should I continue using, for example, the cost of $50,000, or if there is, for example, any reason to think that it will be more relevant, more useful information to be provided if I will be revaluating and using the fair value. Then I can switch and, for example, revalue my asset. For example, assuming that the fair value is 60,000, so I should report now my asset at 60,000 in my books, okay? But of course, to be able to report that information in this balance sheet, we should of course make a journal entry before that, okay? So let's take this example, okay? Here, this is about the Network Rail. That's the Great Britain firm that it's using the fair value, of course, to account for the reward network. So this actually use or switching from cost to fair value made an increase in the long-lived tangible asset by £4,289,000. Okay, that's really important. Okay, and this increase actually, or this effect of valuation should be reflected by making journal entries. Okay, so here we should what, adjust the asset account and what recognize what we call unrealized gain if there is of course an increase, because it can be also decrease. There is room to both of course situations. Okay, so revaluating an asset, and if I revalue an asset and this change will make, for example, increase in the value of the asset, then of course I should adjust the asset account. So I should of course debit the asset account with the difference, and I also should record and realize it gain. Okay, and this is what we call also revaluation surplus. Okay, we can use unrealized holding gain or loss account, or also the revaluation surplus account. Okay. So let's take this example to see, of course, how to deal with the revaluation issue. Okay, so Siemens Group here purchased land for 1 million on January 5th. The company elects to use the revaluation accounting for the land in subsequent periods. So at December 31, the land's fair value is 1,200,000. So this is the situation. I purchased the land for a cost of 1 million. So initially, on January 5th, I recorded land for 1 million. Now, December 31. I decided to use the fair value to account for my land. So the fair value of this land is 1,200,000 at December 31. So to adjust my asset account, I should what? I should debit land for 2 million, for this 200,000, excuse me, for this is the difference between 1 million and 1,200,000. And this is what we call revaluation surplus, or unrealized gain on revaluation, unrealized gain on revaluation for land. Okay. So please, don't confound this unrealized gain on revaluation with, remember, the unrealized holding gain or loss, that's the income account. Why? Because for revaluation issue, even if the IFRS allows the businesses, of course, to proceed with the revaluation of their long-lived asset, etc., any gain because of that revaluation should be reported as part of what? As a part of the equity account. So it should be increasing the other comprehensive income in the statement of comprehensive income. So it is what? Please, in particular, talking specifically regarding the gain, because of that, the revaluation. So the unrealized gain on revaluation, that's an account which will be increasing the other comprehensive income in the statement of comprehensive income. So meaning that's an equity account. Okay. So let's assume now if we are here revaluating a depreciable asset, because in this prior example it is a land, so there is no depreciation, there is no problem. Okay, now if we are revaluating an asset that is depreciable, okay, so assuming that we have the equipment for 500,000, that's the cost on January 2nd, we have useful life of 5 years, that is depreciating using the straight line method, and its residual value is 0. So now we are really simplifying the issue here, okay? Lenovo chooses to revalue its equipment to fair value over the life of the equipment. So we should record, of course, depreciation expense at the end of December. So first thing, we have actually two things to record or to take into consideration. We should first record depreciation expense for the 1 year used from January 2nd to December 31. And then we should, December 31, also account for that revaluation, okay? So here we have what? We have 500,000 less 0, which is the residual value over 5 years. So we have 100,000. That's the annual depreciation expense that will be recorded, okay? After, of course, this journal entry, what we got? We have the carrying value or amount that is now 400,000. And after, of course, if I'm thinking, of course, to use the revaluation or to use the fair value, I should what? Call for external or independent appraisal, okay, to provide me with the fair value of that equipment. So it said that the fair value of the equipment is 460. So what we do now is that I should what? I should take off this accumulated depreciation and also credit the equipment for 40, and of course record the unrealized gain on revaluation equipment by 60. So just need to explain that journal entry quickly. If we are dealing with the depreciable asset, okay, so to be able to adjust the new or this depreciable asset to its, of course, 460. Please, we compared the carrying amount to the, let's say, the fair value. So the carrying amount was 400 and we have a fair value that is 460. So we have a gain on revaluation that is 60,000, okay? At the same time, my equipment, it is actually reported on my balance sheet at its original cost, which is 500, okay? So it should be credited by 40,000 to meet the 460. But at the same time, don't forget that I will take off the accumulated depreciation. علاش؟ على خاطر the new, let's say, original cost of my asset will be the 460. This is what the journal entry here is saying, okay? So please, just to put it simple in your minds, when you have to deal with the depreciable asset to be revaluated, okay? Of course, you should see if it is gain or loss by what? Comparing the carrying value with the fair value, okay? At the date, of course, of the appraisal or of the revaluation, okay? So this is the situation. We had what? We have 60,000 as gain. At the same time, قلنا we should adjust يعني احنا تصوروا equipment بتاعنا originally it was debited by 500. Now I should state it at 460. So how can I state it at 460? So I should credit by 40,000. But and the new carrying value of that asset, it is 460. كان باش نخليها هذه accumulated depreciation without taking it off, without debiting. donc باش تكون عندي قداش؟ باش تكون عندي 360 as carrying value, which is wrong, okay? The new carrying value of my asset now, it is based on this fair value of 460. That's the meaning of taking out this accumulated depreciation for 100, okay? Is that clear? I guess you are lost.
مدام
قل لي.
معناها نحن من الأول قيدنا depreciation متاعنا ومن بعد when we had the fair value معناها revaluation كان لازمنا معناها نرجعوها through معناها عملنا الديبت متاع accumulated depreciation وحطينا الجين في الكريدت هكا ولا لا؟
باهي أو شوف نعاود just نرجع احنا في the first situation we had situation when we purchased an asset for 500. We should at the end of December 31 we should what? Measure depreciation expense, so we have 100,000 and accumulated depreciation 100,000. But at this level قبل ما نحكيو على revaluation what I have and can you نرجعوا للبالانس شيت حتى to present our financial of course statement and assets in the balance sheet. كيفاش نعمل presentation؟ وتلقى عندي equipment it is stated at 500,000, that's the original cost. نجي تحت نحط accumulated depreciation 100 وعندي book value or carrying amount now it is 400,000. هاك ولا؟
Yes.
That's the initial situation. باهي احنا مازلنا مش في الوضعيه هذيك على خاطر علاش؟ على خاطر عندنا another issue. The other issue is that as a firm I decided to, let's say, abandon the historical cost process and adopt the fair value here valuation method, okay? But if I want to adopt the fair value, donc هنا عندي fair value measurement that should be compared to the carrying amount. donc عندي carrying amount it is 400 وعندي fair value that is 460. donc هالrevaluation هذه عملت لي revaluation surplus، عملت لي gain of what? Of 60,000, okay? باهي donc أنا what I should report in my balance sheet because of that situation. I should now report my asset at 460,000. That's the fair value. That's the new carrying value of my asset. Okay, now to be able actually to show that 460 in my balance sheet, I should adjust by making journal entries. Okay, donc I used to have initially قبل الريفالويشن عندي 500 less 100 وعندي 400. Now أنا نحب نوريها هالequipment instead of 500 it is 460 وما فماش bien sûr يعني it is entirely 460. دونك باش نعمل I should adjust the asset account. دونك هو خاطر ديما الاسيت account قلنا راهو it is presented at the original cost. Donc even though عندنا accumulated depreciation but this is the contra asset account على ذاك نحطوه just below the asset account with the original cost. So then نحسب book value. Okay, donc أنا after revaluation my book value should be 460, and that's not only book value, that's the way asset should be reported. Donc ما عادش عندي ريتها كل difference at this level. نحط original cost ومن بعد نعمل less accumulated depreciation بعد نحط carrying value. No, if I decided this is the first year of course of revaluation, I should what do? I should report my asset at 460 as if it is the new cost of that asset. To be able to report this asset as 460, I should proceed with some adjustment. أول حاجة أنا equipment it has a balance, debit balance of 500. So to meet the 460, it should be reduced by 40. Okay. At the same time, I recorded 100,000 as accumulated depreciation. Now I should undo that by debiting that amount, and of course the difference will be كما قلنا between the carrying amount and the fair value. That's the 6,000. That's the revaluation surplus. That's the gain. Is that clear?
Yes, Professor.
Okay, good. Hope so for the others. But you see here, that's the illustration of when we are providing the statement of comprehensive income and also the balance sheet. So for the statement of comprehensive income, this is the unrealized gain or revaluation. It should be what? An item of the other comprehensive income here account, which is, as I said, an equity account. For the statement of financial position, you see here, now we have equipment that is reported at its fair value now at 460. We don't have any accumulated depreciation. The new carrying amount is actually equal to the fair value that we use it in 2019. Okay.
Yes.
Okay. This is of course the accumulated other comprehensive income. That's of course 60,000 because here we assume that this is the first year of revaluation. This is the first time we revaluate, so we don't have any additional items. So the entire year, the unrealized gain will be the 60,000. This is the accumulated other comprehensive income. Okay. So under no circumstances can the accumulated other comprehensive income account relate to revaluation have a negative balance. It makes sense. علاش؟ على خاطر just one thing. This account will only show actually the revaluation surplus, meaning the gain. Okay, because if we incur losses on revaluation, this won't be an equity account, will be an income account. So here to just summarize the issue is that for IFRSs, if you proceed with, or you are free of course to use the fair value, and even you are encouraged to use the fair value for certain types of assets like financial asset, etc. The same time, so if you have here when we're talking about the fair using the fair value for long-lived asset, then that's really particular. Please, it's important to say that. So this, we're talking about the long-lived asset, the revaluation of the property, plant, and equipment. Okay, so here for the IFRSs, if you opt for, or if you want to use the fair value for a revaluation or revaluation process, I mean, for revaluating your property, plant, and equipment, any revaluation gain or surplus should be reported as an increase in equity, okay, under the other comprehensive income item. While if you have a decrease in your fair value, so you have what? You have a loss and this loss, for example, if you assume the next year you will have a loss. So, for example, we initially have fair value 460. Next year it is 420. So we made a loss of 40. So this is a loss, and this loss will be reported as an income in the income account. Okay, in the income statement, I mean. Okay. So just to talk quickly about some revaluation issues, okay? So as a firm, I can elect to value only one class of asset, meaning if I have, for example, equipment, I have building, I have land, etc. So I can pick only building or equipment or machinery or land, but if I want to, for example, revalue land, so all land loads, let's say, included in this account will be revalued. Or if, for example, I elect to use the fair value for equipment, all the equipment within this category should be valued at fair value. Okay, so you see here, I should just, for example, use the fair value for buildings, but all the buildings that are included in this account should be valued at fair value. And then of course, I should continue using the cost for land or for equipment. Okay, so this is what I'm saying. So one class of asset, of course, should be the grouping items should be also valued at fair value. Okay, is that clear, please? Yes. So just here, as I said, 5 minutes, and we will close the chapter. So in addition, of course, to this, of course, journal entries and to the balance sheet information and income statement, etc., we should also make specific, of course, disclosure regarding the property, plant, and equipment. Okay, so remember that when we're talking about depreciable asset, we talk about accumulated depreciation that will be provided as a contra asset account within the balance sheet. For depletion, I just step that it's about, of course, natural resources that will be. So can I hear about depreciation of natural resources? It's about depletion. Bon, c'est pas grave. We didn't cover, so we can omit that. So as disclosures, we should provide in the notes disclosure additional information regarding, for example, the basis of valuation. If I'm using the circle cost or the fair value, okay? If there is any pledges or lines or other commitments. So if I'm, for example, giving or using, for example, land as collateral, for example, for any money borrowed or whatever, so it should be also given as information because it is important to be provided. Okay. Okay, so we'll stop at this level. Next time, it's not really. I just choose not to cover because I assume that you already have it in FSA. Return on asset, all these ratios. You may have covered in the FSA, okay?
Yes, we covered them this morning.
Okay, so you have here, please, an appendix here, a revaluation, example of property, plant, etc. You can read it, of course. This is a reverser, etc. Anyway, مش مشكلة. So we will cover together because it is really important and interesting, okay? Now we will cover together next time. به جمعة جاية إن شاء الله. It will be inshallah face to face, okay? So thank you for your attendance today. I'm really sorry for that rhythm, for not being able to be there. I had really an emergency. Anyway, so next time, of course, we'll meet face to face. And please, if you have any problem, any issue, any even inquiry or a suggestion, etc., please do. Okay, I'm all ears. I can receive your emails. I can discuss that in presence. But of course, I make sure that all what we covered will be really understood. Okay, thank you, and see you next. على خير.
سلامة مدام.
سلامة. Wow.
Thank you.
You're welcome.